Welcome everyone, I hope you're all having a great weekend. In this video, we're going to be talking about, of course, the market sell-off and why I'm not personally worried about it. This is one that doesn't really concern me. We're going to go over that. We're also going to look at my portfolio, the passive income account. This is a dividend growth portfolio, and we're going to see the damage that's done, what type of holdings I'm buying, and a big dividend pair that I'm actually going to be buying soon. So we'll be talking about that in this episode. But before we go into that, I want to go over this market sell-off and just go over some of the subtle hints that I've given over the past couple months that the markets have become frothy, that investors are becoming careless, and the market is ripe for a pullback. 2 months ago, I made a video called A Warning to ARK Investors, Cathie Wood. In this video, I talk about how investors were chasing returns. They're piling their money into the best performing funds, which were then ran by ARK Invest. Usually when this happens, when investors see a fund like ARK Invest or the Genomics Fund or the different ARK ETFs, and they see the great performance of it going up 150% in 1 year, and they start to pile all their money into it after that happened, usually those funds go over a period of underperformance. They have significant pullbacks. And we're now seeing that with ARK Invest. The fund is down around 25% since the time I made that video. Just 5 weeks ago, I came out with a video called Why Investors No Longer Care About Risk. Here's the intro to that video.
Everything's going up. Stocks only go up. This is the easiest game I've ever been a part of. You buy your planes, you buy your trains, you buy your automobiles, you buy your casinos, and you're rich. You're rich. You're Scrooge McDuck rich.
The reason I started this video 5 weeks ago with this clip is because I thought it embodied the attitude of the investor at that time. That's how most investors felt, that you can buy anything and it goes up in value. You don't have to pay attention to valuations. You don't have to pay attention to the underlying asset. You don't have to pay attention to the price to sales, the PE ratio, the multiple, the market cap. None of that matters. You can buy anything and it will go up in value in the next week or the next 2 weeks. That was 5 weeks ago. Now, just a week after that, my very next video, again, this was 1 month ago, it was titled How to Get Rich Quickly and Easily. In this video, I unapologetically mocked different TikTok gurus giving terrible advice. Here's an example of it.
Here's my strategy in a nutshell. I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it, and I do that over and over, and it pays for our whole lifestyle.
That's the type of investing advice we get on TikTok, and this video had millions of views. A couple million views at least, and then he shows screenshots of making $20,000 a month doing his strategy of buying stocks before they go up and then selling them before they go down. What a novel strategy that is. Now, a week after that, just last month, I came out with 2 videos on the subject of GameStop and how this rogue group of investors from Reddit use social media with high amounts of margin to blow up a hedge fund out of a short position. When this happened, it drew national attention. Saturday Night Live was making videos about it. Every cable news network, every political channel was discussing GameStop stock. People who never have invested before and didn't know a thing about stocks were now interested in the stock market. Millions of new people are signing up for Robinhood and being introduced because of this national story. And as they say, when the shoeshine boy starts giving stock tips, you know things have probably hit a top. This was just last month. Charlie Munger, who was also viewing this activity in the stock market over the past couple months, gave his opinion on it, and he was criticized for being elitist.
Most egregious in the momentum trading by novice investors lured in by new types of brokerage operation like Robinhood. And I think all of this activity is regrettable. I think civilization would do better without it.
That's his opinion on it. Charlie Munger thinks that civilization would do better without this speculative momentum investing. And what he's describing is very much like what that TikTok investor just told 2 million people of how he makes his money. Buy stocks before they go up, sell them before they go down. Simple as that. Charlie Munger is saying that that's egregious and that the world would do better without it. Then just 2 weeks ago, the next video I did after that one was titled How to Invest in a Stock Market Bubble. I pretty much came to the realization that we are in a market bubble. Some companies have extremely high valuations. The market was being careless with risk. There was memes like Dogecoin getting bid up to $1 billion market cap. This was very careless, reckless, risk behavior by investors, and it became obvious. So the advice in that video was to buy quality companies with lower valuations that are less speculative. Focus on companies that make real products, real profits, and you'll probably do better once this bubble starts to unravel a bit. And then, of course, the next video after that, the most recent one, was yet another warning about hyperinflation from Dr. Michael Burry. So this has been the theme over the past 2 months on the Joseph Carlson YouTube channel. Warning after warning about the market becoming frothy, investors becoming careless, social media gurus on TikTok and Twitter giving terrible investing advice to millions of people, and then things like memes becoming worth billions of dollars in market cap, warnings that Michael Burry are giving about inflation. It was clear to me over the past 2 months that we had reached a point that the market was becoming frothy and you needed to bring your investments to a less speculative level, to really high quality companies that produce cash. And doing that has offered protection. On the other side of things, we have the SPACs. Many of them are complete garbage companies peddled out by people to sell into the public markets so that they can become rich in the process. And these companies, which were touted just a couple weeks ago as being easy ways to earn 20 or 30% in a couple months, are now getting crushed. I had people that are big into SPACs comment on my channel and say, why are you investing in boring dividend companies? These returns that you're earning in a year, you can earn in 2 weeks with SPACs. Look what's happened to SPACs over the past 2 weeks. When they first started, in aggregate, over the past 2 months, they gained on average 20% returns. That was incredible performance. But many of these companies, I believe, are overvalued. They're not quality companies. They don't have quality business models. And as a result, as soon as there was any trouble in the market, the first companies to be sold off were the SPACs. They're now down in aggregate about negative 10%. So most of them dropped around 30% in the past 2 weeks. Other more speculative investments that have been hit over the past couple weeks is the ARK Invest ETFs. Most of them are down around 20 to 25%. That's a pretty good haircut, losing 25% of your value in just a couple weeks. Now, the companies in ARK Invest, I think, are better than most of the companies that are SPACs. These are ones that have good quality business models, but their earnings are way out in the future. They trade at high multiples, and it'll probably take time for ARK Invest to really recover back up to the point it was. But I still think that most of these companies are high quality for the long term. And then, of course, we have the NASDAQ 100, which leans more into those high-tech companies that are a little bit more growth-centered. And this one has also traded down around 8.25% since its recent high just a couple weeks ago. It's a pretty good dip right there. 8.25%, that's no joke of a dip. That's a pretty significant number. Now, going through these type of investments that have really been punished over the past couple months, you notice the trend here. They're all the more speculative type of investments that I've been warning about for the past 2 months. The SPACs, the less proven businesses with what I think are inferior business models. The ARK Invest type of companies. These are high quality companies, but they're very big bets. They're more speculative in nature, and their future profits are more out in the future. These are companies that usually run at a loss right now, and their profits are somewhere 5 to 10 years out in the future. So they're not quite considered as much of a sure thing today. Now we can compare that to my portfolio. This one is focused around passive income. I earn passive income through dividends. They pile into my cash balance, and I redeploy that continually throughout the months. I get money in my cash balance, $100 here, $200 there, and I use that money to buy more shares in what I think are undervalued companies. Now, this one is not a speculative portfolio. I don't focus on these companies that are these huge bets of money out in the future. I'm focusing on companies that are making money right now. Companies that have high amounts of free cash flow, they generate a lot of cash, and they can pay that out to their shareholders. That is most of the companies in this portfolio. So the gains may not be as incredible in the short term, but it should have steady compounding over numerous years. That's what I'm looking for in the passive income account. I do have some growth companies. I have some more growth center type of investments. Apple and Microsoft and IGV, I consider very much growth oriented. So of course, these ones have been hit harder over the past month, but in aggregate, the portfolio has performed really well. In fact, if I look at the past month, I'm down 3%, $6,000. In whole, $6,000 is not a small amount of money, but 3% is a very small amount to lose over the past 30 days. In the past week, I'm down only 0.61%. My portfolio usually moves around like 0.5% in a day. So it's always bouncing up and down $1,000 or $2. So that's really not a big deal for a week. And then in the past day, it recovered a little bit, the recent bounce back in the market late Friday, and it was up almost 0.9%. So this is what you're getting when you invest in this type of portfolio. You're getting a constant stream of income, constant dividends. I can look at my activity feed and see what I've been paid out. Here's the type of activity I have happening in this portfolio. I got paid $7 from Visa, $30 from Costco, Realty Income Corp paid me $15, AbbVie paid me $23, Apple paid me $38, MasterCard paid me $6, Verizon paid me $20, JP Morgan paid me $150, AT&T paid me $110, Comcast paid me $15, Simon Property paid me $39, which Simon Property, by the way, has completely recovered in stock price. I'm no longer in the red in this company anymore. So this is one that sold off by over half. Over half the company sold off. Now it's back in the green. That's what you get for holding onto a company. Then we have Store Capital paying me $160. And this goes on, page after page, that I'm earning through dividends that I get to reinvest back into the market. Now that is exactly what I like to see with this type of portfolio. Dividends being paid to me in cash every single week and every month, building up my cash balance so I can deploy that money back into undervalued companies. Now I'm also trying to get market gains as well. So I try to have both of them, a lot of earned dividends, a lot of dividends paid to me, as well as capital appreciation. And I try to get both of those goals. And I think so far this portfolio has done a pretty good job at that. Now, one holding that I've introduced to my portfolio to help with this goal of generating passive income is a new slice. It's a new pie in my M1 Finance portfolio called Income Fund. If I click on this, I have $7,000 invested in it. I just started a position last week when I saw things trade down a little bit. And the ticker symbol's called JEPI, J-E-P-I. That's the ticker. It's JP Morgan's Equity Premium Income Fund. This is a high-yielding, cash-producing asset. It has a dividend yield yearly of anywhere from 6 to 10%. The amount that it pays out monthly can change month to month, but it does produce a lot of cash. 6 to 10% dividend yield is incredible in this low yield environment that we're in right now. Now, let me go ahead and explain how this ETF works. We'll go over to JP Morgan's website. First of all, this is an actively managed, transparent ETF that's similar to the ARK Invest ETFs. Actively managed, meaning that there are portfolio managers managing this ETF. Now, obviously, I think JP Morgan's a very good bank. I think it's one of the best asset managers in the world. That's why I have $25,000 invested in the bank itself. So it does have active managers. They're employed by JP Morgan. They're the ones running this fund, and they actively pick out the investments in this portfolio. And the transparency means that you get to see what they're doing every single day. There's no delay with it. It's completely transparent. So this is an actively managed, transparent ETF, and we can read its stated goal. It's designed to provide current income while maintaining the prospects for capital appreciation. That sounds exactly like the passive income. I want to have lots of current income, and I also want to have capital appreciation. Now, they try to accomplish this goal through a specific strategy. They say they're going to generate income through a combination of selling options and investing in US large cap stocks, seeking to deliver a monthly income stream, associated option premiums, and stock dividends. So in this ETF, they're basically using a strategy of investing in large cap US dividend paying stocks, and they're also selling options on top of that to help generate this high amount of monthly income. And I've seen some individual investors doing that, but with this ETF, you're basically outsourcing that work of selling the options to JP Morgan. They have professional managers doing that for you, and they distribute the gain monthly to you. They say they construct a diversified, low volatility equity portfolio through a proprietary research process designed to identify over and undervalued stocks with attractive risk return characteristics. This is where the active management comes in. They don't just invest in the S&P 500, they pick companies out of it and they do different weightings with it. So it is a different portfolio, and they are trying to beat the S&P 500. They want to have a better risk-adjusted return. They also say they seek to deliver a significant portion of the returns associated with the S&P 500 with less volatility in addition to monthly income. So they're trying to spread the gains of the S&P 500 over a year on a monthly basis. Through call options, through dividends, they're trying to get the gains and give them to you on a monthly basis with dividends. So when I look at the goal of this ETF, to deliver monthly income and a high yield to me on top of capital appreciation, I think that fits really well with my portfolio of passive income. It fits right along with my goals of it. And with JP Morgan managing this product, it gives me more confidence with their ability to accomplish this goal. Another thing I think is cool about JEPI is this is the ETF version of a product that JP Morgan already offered, but it only existed for their super wealthy clients. They've previously had a mutual fund called the JP Morgan Equity Premium Income Fund, but on the prospectus, on the fact sheet, it says the minimum initial investment was $1 million. So this is a product that only realistically the super wealthy could buy into. But now JP Morgan's offering these type of products to people like you and I that don't really have $1 million to throw around into it. So I think it's cool that they're starting to do that now. Now, I plan on building this position up to be much larger in the future. So I have $7,000 invested into it right now, but I'm probably going to build it up to a $10,000, $20,000 position over the next few months, at least maybe over the next 6 months. So I'll be adding more and more money to it. It'll increase my monthly income substantially and the overall yield of this portfolio substantially, because that is the goal after all, is to have supplemental passive income and to build up holdings in these good companies over time. So that is the latest change to the portfolio. Overall, I am not worried about this stock market sell-off. I think that most of the companies getting heavily punished right now were the very speculative, high multiple companies that are less proven than the ones in my portfolio. So as we go into this, if we do have a continual sell-off and it bleeds into some of these companies, I'll use them as a buying opportunity. That's the way that I view it. But I think if you're invested in solid companies, just hang on to them. Over the past month, I have done no selling. All I've done is done buying. I haven't sold out of any of these companies. I haven't panic sold out of any positions. I just hold on to them, reinvest the dividends, and buy back into good companies. So I hope you guys enjoyed this little update. Make sure to subscribe to the channel if you haven't already. I'll be showing you week by week how this portfolio performs. Every single week, the total returns, nothing hidden with it. You get to see the performance over and over again every week, and we get to see how this plays out together. I can't see the future, so maybe the sell-off will continue. Maybe we'll have a big rebound. But either way, I'm going to show you the results here every single week. I will talk to you guys next time.